2025 has completely rewritten the rules of UK property, and yet most people barely notice. Mortgage stress tests, which have stopped countless buyers for over a decade, are quietly being relaxed. For years, banks have asked, can you afford your mortgage if interest rates jump to 7, 8, or even 10%? Many were rejected despite easily affording payments at today's rates. Now the Financial Conduct Authority, FCA, is saying, use realistic market rates. Don't lock people out unnecessarily. This subtle but powerful change means more buyers can finally get approved. Remortgaging is easier, borrowing terms can be shortened without drowning in paperwork, and smaller lenders can approve loans up to 5 or 6 times a borrower's income. The government has also launched the Mortgage Guarantee Scheme, encouraging lenders to lend more and faster. On the surface, this seems like a win for buyers. More flexibility, more approvals, more freedom to switch lenders. But there's a hidden risk. Every time borrowing becomes easier, demand increases. With supply still constrained, house prices could surge again. For first-time buyers, this is an opportunity like no other. For existing homeowners, it could mean your property is suddenly worth more, or that competition becomes fiercer when you sell. But is this move really about helping people? Or is it a clever strategy to prop up house prices and stimulate the economy? As interest rates trend downwards, lenders are now allowed to test mortgages against realistic 5-year expectations instead of outdated, sky-high assumptions. Consumers have more freedom to negotiate with lenders, explore options informally, and reduce borrowing terms. Essentially, the FCA is saying, innovate, be flexible, and make it easier for people to move. But caution is advised. With the supply-demand imbalance still critical, the market could overheat. Buyers and investors need to stay informed and strategic. The landscape is changing fast, and those who understand these shifts will have a distinct advantage. While mortgages are easier, the supply side of UK property is experiencing its own dramatic shift. Rightmove and Zoopla report the highest number of homes on the market in over a decade. Listings are up 10% year on year, while buyer demand has only increased 4%. Suddenly, sellers are chasing buyers, a complete reversal from the market of recent years. Why are sellers flooding the market? Many purchased homes during the ultra-low mortgage deals of 2021. With rates rising now, some are facing a 30% or more increase in payments. Others simply cannot refinance and are forced to sell. This has created a tidal wave of supply hitting the market, slowing price growth. Zoopla forecasts just 1.5 to 2% price growth in 2025, essentially flat when adjusted for inflation. It's a fascinating paradox. Supply is surging, which usually stabilizes prices, yet affordability concerns and interest rate shifts are making buyers cautious. The government and regulators are aware. Easier borrowing is essential to keep the market moving. Otherwise, a sudden collapse in transactions could destabilize the housing economy. This is not just numbers, it's human stories. Sellers facing mortgage pressure. Buyers uncertain whether to act or wait. Investors rethinking strategies. The market's complexity in 2025 is unlike anything seen before. Those who ignore these trends may miss crucial opportunities or make costly mistakes. Even with increased supply, the market remains fragile. If mortgage approvals continue to rise, it could temporarily increase demand and push prices higher despite record listings. On the flip side, buyers may still struggle to compete in sought-after locations, especially where corporate landlords dominate. The rental market is facing a dramatic transformation. Small landlords, those with 1 or 2 properties, are leaving in droves, driven out by new regulation, reduced tax relief, and uncertainty around the Renters' Rights Bill. These are often the landlords most personally invested in tenants, offering flexibility, understanding, and local trust. Who's replacing them? Big corporate landlords. Companies like BlackRock, Legal & General, and Lloyds Bank are buying thousands of homes, often entire developments, before they even reach the market. Unlike small landlords, they treat tenants as numbers and adjust rents strictly according to market conditions. Emotional investment and personal service are replaced by spreadsheets and profit margins. The consequences are profound. Short-term rental supply drops, rents rise, and wealth inequality grows. Policies intended to protect tenants are unintentionally favoring corporates over small, community-focused landlords. Essentially, the market is being corporatized, with large investors profiting from a system that increasingly sidelines ordinary people. As small landlords exit, flexibility and personal care vanish. Corporate landlords with deep pockets and massive portfolios dominate. Tenants face fewer choices and higher costs. The UK rental market is evolving rapidly, and the traditional landlord-tenant relationship is disappearing. Finally, a looming threat could affect almost every homeowner: a potential land value tax. HMRC collected $15 billion in stamp duty last year, but leaked proposals suggest a new levy on homes over $500,000, potentially replacing council tax and stamp duty. Imagine your home suddenly subjected to this new tax, combined with rising rents, corporate landlords dominating, and changing mortgage rules. The UK property market could be turned upside down. Mortgages are easier to get, supply is up, but taxation and market dominance by corporates create new challenges for homeowners, investors, and tenants alike. The market is no longer the same. 2025 has rewritten the rules for everyone. Every buyer, seller, and renter must navigate a landscape where mortgage flexibility, supply changes, corporate landlords, and taxes all collide. Understanding these forces is essential to protect your financial future.